Welcome, everyone. If I could just ask everyone to mute the moment just for us to start the introductions. Assalamu alaikum, everybody. Good afternoon. On behalf of our Board of Directors and Executive Management, I'd like to welcome you to the National Finance Company's mid-year investor meeting. My name is Wissam Al-Saeed, and I am the Chief Marketing, Communications and Sustainability Officer here at National Finance Company. Thank you for joining us all today. We value the continued trust you place in our company, and this platform is a reflection of our commitment to transparency, performance, clarity, and open dialogue with you, our respected stakeholders. Today's session will provide an opportunity to discuss the financial results for the 6 months period ended 30th June 2026. These results have been disclosed on the MSX platform as well as this session, as usual, will be conducted entirely in English. However, we are happy to answer any inquiries in Arabic if needed. We will allocate to hear your questions and inquiries. Before we proceed, let me introduce the esteemed members of the National Finance team who are present with us today, starting with our Chief Executive Officer, our Deputy Chief Executive Officer, Mr. Rakesh Makkar, and our Chief Risk Officer, Mr. Bikram Monga, our Chief People Officer, Ms. Marwa Al-Kharousi, and our Deputy Head of Finance, Mr. Nirosh, as well as our Communications and Investor Relations Supervisor, Ms. Amira Al-Khatri. We would like to emphasize that the main purpose of this session is to highlight the company's performance for 6 months period ended 30th June 2026. And we do not intend to promote the company's products and/or investments in this platform. I will now hand over the floor to our CEO, Mr. Tariq Al-Farsi, to begin the session and provide his insights.
Thank you, Sayyida Wissam. Good morning, everyone. And thanks again for joining our H1-2026 investor presentation. Our 5-year strategic plan remains firmly on track, and the first half of 2026 demonstrates continued execution across our strategic priorities. Despite spillover effects from regional uncertainties, we managed to re-engineer our approach and continue to increase our market share. As a result, National Finance continues to be the largest finance and leasing company in Oman with over 50% of the market share, over 70,000 active customers, and a network of 24 branches. Our gross loan book has grown to 760.6 million Riyal Omani, while maintaining disciplined risk management and a net NPL of 5.9%. Our main shareholders continue to remain unchanged, once again a testimony to our stable and prudent operations. We remain focused on sustainable growth, disciplined underwriting, and delivering long-term value to our shareholders. Slide 6. Our diversified product offering continues to be one of our key competitive strengths, serving corporate, SME, and retail customers. Our strategy continues to favor portfolio diversification and lower ticket sizes to improve resilience during market volatility. We continue to maintain a diversified funding portfolio, a profile across equity, deposits, bonds, and bank borrowings, providing a strong platform for future growth. Going to slide 7. Our board and management team remains stable and highly experienced, with more than 140 years of cumulative industry experience. Our board continues to be led by Mr. Hani Al-Zubair and Mr. Abdulaziz Al-Loushi as a deputy chairman. I'm also pleased to announce NFC welcome on board 2 new directors during 2026, Mr. Fahd Al-Balushi and Mr. Wadah Al-Adawi. The management committee, which was already introduced to you, continues to drive execution across operations, risk, people, strategy, marketing, and sustainability. Slide 8. We also continue to dominate the geographical landscape of FLC market with the largest outreach with 24 branches. Our blend of both digital and physical channels continue to help us outgrow our competition, which in turn continues to get recognized with the awards. Slide 10. We continue to outperform the market, maintaining approximately 50% market share by net loan book. And also in H1-2026, income from finance activities increased by 10.2%, while net profit grew by 15.2%, about 8.1 million Riyal Omani. Despite a challenging operating environment, we achieved healthy loan book growth while maintaining strong asset quality and disciplined provisioning. Our capital position as well, funding profile and profitability remained among the strongest in that sector. With that, through the rest of the presentation.
Thank you, Tariq. Good afternoon, ladies and gentlemen. A quick overview on our financials. If you look at our financials, we deliver another strong set of results during the first half of 2026. Our income from finance activities increased by 10.2% to RO 38 million, which was supported by continued portfolio growth. We have grown by 5% as compared to last year, which reflects the momentum that we have in terms of asset growth and business. Net finance income increased by 17.7%, while our core income grew by 17.6%, reflecting both healthy business expansion and effective management of funding cost. On an overall basis, like Tariq mentioned, profit before tax increased by 16.7% to RO 9.6 million, while our net profit reached RO 8.1 million, representing a growth of 15.2% compared to last year. Moving on, this slide reflects quality of our portfolio and sustainability of our financial performance. Like mentioned, our loan book continued to grow steadily to approximately RO 761 million, while the net loan book reached RO 686 million. That's 5.5% growth compared to first half of the last year. If you look at the bottom graph, although the stage 3 ratio increased slightly compared with year-end, however, our portfolio remains one of the strongest in the industry, and we are continuing to provide and add more provisions as we grow over a period of time. That's the positive side, and the right-hand side shows you consistent and healthy financial performance. Those are pictorial presentation of the financials that we discussed just now. Moving on. Our capital position remains strong and provides a solid foundation for future growth. We maintain a diversified funding structure consisting of equity, perpetual bond, corporate deposit, and bank borrowings, ensuring both funding stability and liquidity. Our gearing stands at 3.85, very comfortable and much below the regulatory cap of 5 times as per CBO guidelines, which actually means we are very strong and have enough buffer to grow over the period of time. If you look at our returns, ROE, it continues to improve, and for the year we had ROE of 11.74%, while return on asset remains stable at 2.3% for us. In addition, we have maintained a consistent track record of increasing cash dividend and bonus share distribution over the years. We thank you all for giving us time to present our financials and our performance for the first half year. We'll be happy to take any questions from all the participants. Thank you.
There's any questions from the audience?
It's very strange. So, just
Okay. Just one.
selection and route.
Hi, sir. Hi, sir. Just wanted to have some more detail on the increased provisioning undertaken for this quarter. If you can give slight brief about it.
Sorry, what's exactly, what do you want to know about the provisions? It wasn't clear.
In the Q1 financials which have been presented, there is increase in the provisioning undertaken for the quarter by around, I believe, 30% odd, from 5 million to around 8 million, if I'm not wrong. So just wanted to know a bit more details about the same.
So during the first half, which is the H2 that we are presenting, the provisioning is an element of two aspects. One, it is directly linked to, our model output, which is that's one. And two, we're always taking additional overlays in terms of ensuring that we've got enough conservative approach. So it's consistent with our strategy, which has been there all along, and in line with the portfolio growth which we've seen.
So basically, the provisioning resulted in line with the regulated downgrades. This is what Beckham was trying to say.
Yeah, the
Also allocated in our additional income prudently because of the outlook.
Along with the incremental assets booked by the company. So it's in line with that, right?
Yes, indeed.
Oh, thank you.
Rahul?
Can you hear me?
Yes, we can.
Yeah, thank you. Thank you for the detailed presentation. I have a couple of questions regarding the impairment charges during Q1 and Q2. During Q2, the impairment charges had declined to 1.96 million compared to 3.40 million in Q1. Can you explain the reason of decline in Q2?
This is mainly because of, if you see our movement in the stage 3 portfolio, there was an increase in the stage 3 portfolio during the Q1. So it has been reflected based on that, and we have provided more. And the second quarter, there is no big movements in the stage 3 portfolio. So based on that, we have provided accordingly. Based on that, we have provided to the as a provision.
The quarter outlook was improved.
So we can expect this trend going forward also quarterly.
I mean to say there is we can expect the same trend to be continue in the Q3 and Q4, but anyway, it is based on the portfolio performance and those things. But we are expecting the same.
We don't expect any shocks.
No.
And also, my second question is related to the cost. Your average cost is 5.9%. If you can put light that what is the average borrowing cost and deposit cost separately?
I must say it is based on the type of the borrowing we are doing. Like in terms of the funding from the bank borrowing, we have a CLTL and the long-term borrowing. So in the corporate deposit side, we have seen the big improvements during the last 2 quarters. So based on that one, I can say this is maybe variable in between 5 to 6%. So we are expecting the same trend to be continue also.
Thank you. Thank you. And also one question is related to the industry overall. So do you see any competition or threat from the banks going forward that the share of financing company may decline?
The competition will always be there. And in fact, we welcome competition because it helps us also to be agile and more customer focused. And so far, we are not seeing any threat coming from the banks. In fact, the thing is that we have been trying to get into customer which are moving out from the bank to us. And this is a reflection of the processes and the service that we give to the customers. So just to give you an example, we added 9,000 customers in the first half of the year, and another 4,000 repeat customer for us who came back to us because of our service. And we continue to invest in technology. Our customer services or lending processes are amongst the fastest. I'm sure you are aware that CBO has now allowed direct debit mandate, which actually takes away a lot of painful process of getting checks from the customer, processing it and all. So we are the first company in the country which is at 85% on direct debit mandate. We are also amongst the first company in the country where we are doing digital agreements with the customer. So all these features help us to be ahead of the competition, but we have to be nimble foot and look at what is happening in the market and be one step ahead. Thank you.
Plus, if I may add,
Yeah.
Rakesh, we have 50% for market. Know very well that our business model is totally different than banks. So even the segmentation focus is different. And in our case, basically, we always consider banks as our basically partners in the growth. So we don't see any competition in this at all. Thank you, Bharat.
Thank you. One last question. So, sorry, I'm taking much time. So, you in your slide, you have mentioned that the coverage, regional coverage is 80% at the end of 2020, second quarter of 2026. If we calculate that, your gross loan at stage 3 is 103 million, and you have provided 74 million. But in formula, you have mentioned that you are adding the impairment or voluntary reserve in the provisions. So what is the number? What is the number of impairment reserve at the end of second quarter of 2026? So if when I was calculating your coverage, it is around 72%.
That amount would be impairment reserve amount as of 30th June 2026 is around 8.67 million. So you can add that one to 70 million. And if you divide it by 103 million, then you will derive the 80% coverage.
Yes, got it. And for where I can find this number in from your balance sheet?
It is under the equity. You go to the reserves, then down, you will find it under the equity impairment reserve, 8.67 million.
Thank you for your detailed answers. Thank you so much.
Any other questions?
There is one hand.
One hand. Something.
Noor,
Yes, hi.
you have a question?
Yes, thank you for the opportunity and congratulations on the great set of numbers. I have a couple of questions, starting with your net finance income. We have seen a decline of close to 9% quarter on quarter, sequential decline in your net finance income, while obviously your loans have gone up on a sequential basis by 3%. So what actually led to this decline, and should we expect this to be a one-off and the growth to continue in the subsequent quarters, or your guidance would be great?
I think this is because of the rain deferment, which basically came from the regulator. So this is just an incident which basically we had to deal with it in line with regulation instructions by deferring the loans for the people who are infected in rain. That's a decline. That's the reason of the decline. It's basically it's a one-off effect. So it's a one-off effect. So basically.
Okay, great. Thank you. So keeping things constant on a similar number of loans, the net finance income should be better in the third quarter. assuming everything else constant, right?
Yes.
Perfect. Thank you. My second question is regarding your coverage. Building on to the question, your current coverage is close to 72% as per our calculations. And as you mentioned, your 8.67 million of impairment reserve that has been there in the balance sheet, I believe since 2024 year end, right? So your coverage has gone down from close to 75% on average during 2025 to now 72%. And that's primarily because of the jump in stage 3 NPLs during the last quarter or first quarter of 26. So should we expect this coverage number to remain at these levels, or do you guys have a target coverage level? Should we expect your provisions to increase to bring the coverage ratio to 75%?
Our focus is to continuously increase our provision coverage. As you mentioned, that the reduction was mainly due to the stage 3 portfolio increase that was happened as a one-off incident. So we don't expect anything to be happen going forward, and we are continuously increasing our provision coverage. So you can expect that same level to be continuing in Q3, and also going forward, we will be increasing the coverage up to the certain levels, but I cannot promise on something about the percentage, but we will continue to increase the coverage.
In addition, I think I'll add that the risk on the balance sheet is reflected in the provisions that we carry. And the earlier higher coverage was due to an account that was classified as stage 2 earlier, but higher provisions were taken. So that account moved into stage 3 without giving any shocks to our additional provisioning. So therefore, I think I'll look at it from a different side, that we make sure that appropriate risk that we carry is reflected prudently on our balance sheet and income statement all the time.
Great, thank you. That explains it. My final question is regarding your gearing. As you have mentioned that your gearing is slightly over 3.5 times, and while the regulatory limit is 5 times, please correct me if I'm wrong, but we have seen other FLCs to be very comfortable on their gearings, and you guys already have a tier 1 perpetual issued. So in order to expand the loan book, would you need additional funding, or do you feel comfortable, with this current funding that you can go ahead and continue with the growth that we are seeing?
We are more comfortable with the current funding level we have, especially this gear ratios increased because of the dividend distribution. So going forward in the remaining 6 months, when we make the profit, it will cause to reduce the gearing ratio. But as I said, if you are comparing with the industry, I think we are maintaining the healthy leverage compared to the other FLCs that utilizing our funds at the maximum level. So I guess that in around 3.5, 3.6 level will be the healthy leverage for us. Even currently, once we make the profit, then once our equity has gone up, the gearing ratio will come down to that level. That's our expectation.
So in a nutshell, we have a capital plan for 5 years, and we do feel comfortable with that.
Perfect. Thank you. Thank you for the answers.
Thank you very much. Do we have any further questions?
Already done.
There are no further questions from anyone? Oh. If there are no, we'll give you 1 minute. If anybody thinks of any question, maybe please come forward. Okay, I think if there are no further questions, we shall close the session. Thank you very much. On behalf of National Finance Company, I would like to extend our gratitude to you all for your presence here today, and of course to the Muscat Stock Exchange for facilitating this session and fostering open dialogue with our stakeholders. This session was recorded and it will be available for view on our YouTube channel. Should you have any further inquiries, please feel free to contact us through our investor relations contact, and we will be happy to accommodate. Thank you very much and have a nice day.
Thank you. Thank you so much.